Hey everybody, good afternoon to you. My name is Brent Moore. It's time for getting started with options. Talking about option Greeks today. What are they? Why we worry about them? How to use them? It's really key. They're really important for learning options. I know we go through a lot of different option strategies through this class if you've been part of this class. And so I felt it was probably a time to take just a step back and review those Greeks. This is more of a beginning level class we're dealing with today, but that's my goal, get you familiar with the Greeks today. My name is Brent Moores. You can follow me on X at Brent Moores CS. I'm also joined by Connie Hill, who's helping me out in the chat. Connie's very familiar with everything I'm going to go through today, so if you're watching live and you have a question, feel free to type that in the chat. Between Connie and myself, we'll do our best to help you out and get your questions answered. And did I mention you can follow Connie on X as well, at Connie Hill CS. Let me hit the disclosures real quick, then we'll get to options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. Don't consider it an individual recommendation of any security, strategy, or chart pattern. Schwab does not recommend the use of technical analysis as a sole means of investment research. And and remember, all investing involves risk, including potential loss of principal. There's your option Greeks right there. We're going to talk about them in more detail today. You can read about those right there if you want. Short options can be assigned at any time up to expiration, regardless of in the money amount, and stop loss orders do not guarantee an execution at or near the activation price. Paper money application, which is what we'll be using, is for educational purposes only. We'll look at individual stocks today, individual options, but just remember, those are not recommendations. They are just examples here. And so we're going to talk about option Greeks. Let me bring up the Thinkorswim platform. And let me just mention this. What are the option Greeks? Maybe you've never heard of an option Greek before. Why are you bringing this up? The option Greeks are just measurements. Okay, so for example, you're driving your car and you want to know, I want to measure of how fast I'm going. You look at your speedometer. That's a measurement. You want to know how much your engine is revving. You look at the tachometer. That tells you how the RPM's there. And so we use measurements in all sorts of things in life. But in terms of options, there are different factors that affect your fortunes as an option trader. I don't care what kind of option trade you're doing. There's different things that affect how well your trade is going to turn out. And we can measure those things with your option Greeks. Okay, so that's what that is. Now, there's a lot of different option Greeks. I'm going to focus on three main ones and then give you kind of a bonus one. In other words, the three main ones that we're going to talk about, and I'm going to do a little abbreviation. And this is like, if you're brand new to options, I think it's important that you learn this. These three. And I want you to remember this acronym. I'm going to write down, I don't know if we would call it an acronym, it's a little abbreviation, PTV, a little mnemonic way to remember it, PTV, to talk about the three biggie Greeks. Now, there's another Greek that I'm going to talk about as well, for those of you who have maybe feeling a little bit more advanced, and that is going to be a Greek that we call gamma. But right now, we're going to talk about delta, which talks about how much the option price is going to move compared to the price of the stock. Right there. That's the delta. Okay? That's the delta. In fact, I'm just going to write these down right next to where we got. Okay, so delta tells us how much the option is going to move in relationship to the price, a $1 move in the underlying stock. Okay? And we'll go through each of these in turn, but let me just give you an overview right here. Then we have one that options change in price as time passes. Okay, a day passes and options change in price. And we have an option Greek that measures that, and that's called theta. Okay? And then finally, of these first three that I want you to consider, Options can change in price depending on changes in price and implied volatility. Okay, we'll talk about that. That's called Vega. Okay, so when I say PTV as kind of a little way to remember it, P stands for the price of the stock. T is easy because T and time start with T starts with time. T theta, time theta, and V, and conveniently our option Greek that we're going to call is Vega, which tells us how much that volatility is going to change. Okay, PTV are the three main ones here. So let's talk about each of these in turn here, and probably the biggie here is delta. Okay, is delta, option Greek delta. It tells us how much that stock or option is going to move in relationship to a $1 move in the stock price. Now, there's different ways to look at delta, and sometimes this presents some confusion to people. Let me put up Caterpillar here for a sec, because I actually have a trade on Caterpillar, an existing trade on Caterpillar. And if I pull this down and we pull up our delta column right here, it's going to tell us how much the move is, the option will move compared to a $1 move in the stock, and it's just an approximation. It's an expensive stock, and this is an option that's not expiring for a long time. This is January 27, that's 2027. But let's just look at this. I have a position on this, and my delta is showing as 0.72. That means a $1 move in the stock price. In other words, the stock going from 372.36 to 373.36 is going to change that option price by about 72 cents. Okay, 72 cents. Or if this, and that's up or down. So if the stock goes down $1, delta is positive. We're going to see this option price go down from 80, I'm just going to use the ask price here, 82.70. Well, let's subtract 72 cents from 82.70. That would make it, well, 82.80, excuse me. That would make it 82.08 approximately. Okay, that's if Caterpillar went down $1 in price. You see how that Greek works? Okay. Now, the confusing thing that sometimes that people have is they go, well, wait a second, is my portfolio really going to change by 72 cents if Caterpillar goes down? Well, Greeks are displayed differently on different pages. The number is the same, 72 cents here. But look over here. Here's my Caterpillar position. This is the contract. Look what the delta shows there. Well, it's rounded, so this is 72, 71, 77, 72. But notice it's not 0.72, it's $72. So what does this mean for me? What this means for me is this Caterpillar trade right now, if Caterpillar were to go down $1, I would lose about $72 approximately in my portfolio. Okay, overall on that. Or if Caterpillar were to go up $2, I would gain about $140 in my portfolio. You guys getting the math on that? So I'm multiplying the dollar move in the underlying stock times my delta, and that's going to tell you the effect on my portfolio. This is important because I may have a different quantity. Let's say I had 10. If I had 10 contracts, I don't, but if I had 10 contracts here, what would this show, do you think? Well, that would show probably about $710. Okay, that would mean a $1 move in Caterpillar would be about a $710 move on my portfolio. Okay, so yeah, the price times $100 per contract. So we can view this in different ways. Realize this is going to give us, on this page here, this is my position statement. It's going to tell me the overall effect on my portfolio. Now, this was kind of a simple example. This is a long call, but I may have different types of trades on here. And it doesn't matter the type of trade on here, but I can see my delta here for Cisco. It doesn't matter what kind of trade. I can look at it and you can say, oh, there's a kind of a weird trade down here that's kind of beyond what we're going to talk about in this class, but I have different contracts, different numbers of contracts. What do I know about this? I know that if Cisco goes up $1, then it's going to have approximately a $93 benefit to my portfolio. Or if T-Mobile goes up $1, I'm going to lose about 76 bucks in my portfolio. Why lose? Because there's a negative sign in front of that. Can you see that? There's a little negative sign. So that means it's going to go opposite the direction of the underlying stock. If T-Mobile goes down, it would actually benefit me because it's a negative delta. So with delta, positive deltas mean they're bullish trades. We want the stock to go up, okay, with a positive delta. T-Mobile is an example of a bearish trade. We want the stock to go down. Similarly, if I go to the trade tab and look at these contracts, notice the sign on all these on all these calls. They're positive delta. Okay, what about the sign on the puts? They're negative. There's a little negative sign in for those. That means we want the underlying stock to go down. Now, these assume a long position. In other words, a position where we're buying the option. If you sell an option, maybe that's kind of weird to you, maybe that's new to you, but if you sell an option, then what we're going to do is we're just going to flip that sign around on that. In other words, if I sell a call, just a naked, plain old call, and I sell it, then it would be like putting a little negative sign in front of these, meaning it's a bearish position. If you're short a call, it is a bearish position. If I sell a put or short a put, then I'm going to switch this around and these would all be positive. That means if I do a short put, it's a bullish position. Okay, now if you have any questions on what I've gone through at this point, please type those questions in the chat, and between Connie and myself, we'll do our best to help you out with those questions. Now, because I want to take us to the next step here. And the next step is the delta doesn't tell us just whether we're bullish or bearish and kind of the magnitude, but depending on the type of trade, we may have higher deltas or lower deltas. Okay, let me give you an example. I'm going to go here and I'm going to do maybe a bearish trade. Let's look at Pepsi. I'm using this as an example of a bearish trade. Stock's going down, trend has been going down. It's not a guarantee it's going to continue to go down, but I'm going to assume that it's going to continue to go down, okay? So I'm going to look for a bearish trade on Pepsi, okay? So what are my choices? One choice is I can go to my long puts, and I'm not going to go out 570 days. Let's just go out 24 days, how about, okay? So I'm going to go to a long put here, and I can see my delta. If I go at the money is going to be the stock price, the strike price that's closest to the current stock price, okay? And that is 130. So I'm going to say here, I've got a negative 48 delta. So what does that tell me? That tells me if I do a long put, in other words, if I buy a put, I want the stock to go down. And if the stock goes down, say, $1, so from 130 down to 129, if the stock goes down $1, I would expect this option price, now I'm going to use that 100 multiplier, I would expect that option price to go from around 345 to, and we said if the stock goes down, it's a negative delta, so it's going to be opposite. If the stock goes down, I'm going to add 48 cents to that. So that would make it 93, I think, if I'm doing my math right, okay? Now, 100 multipliers, so this would be $345, $393. All right, so let's hit up a couple questions here. Kevin said, if you short a put, then the price is, yeah. So if I short a put, remember, if you're shorting something, you're going to reverse that sign on your deltas. Okay, so it would be positive delta, and we'd want the underlying stock to go up. Okay, we want the underlying stock to go up. Okay, and Mr. Friedman says, well, buying a put is a bearish position. Yeah. Do you see the example we just did? If I buy this option for $345 and the stock goes down because the delta is negative, if I'm buying the put, then we would add that delta on there. That's a measure. Okay. So there we go. Okay. Now, let's go forward and let's put this position in, because let's just put this position in. I'm going to just buy this, and I'm not going to fiddle around too much with it. I'm just going to put this order in. I'm going to confirm and send, and I'm going to put this in my long single options group. We're going to buy that. Now we have a long put on here. Okay. Now, so let's just take a quick look at it. And long single options, I've got Pepsi. My delta is negative, meaning we're bearish on this. We want Pepsi to go down, and therefore then the option price would go up. Okay, now you can see, now to question MB said, is it possible to see the delta for the whole portfolio? Yeah, you can see the sum of the deltas. But keep in mind, and this is a little bit outside of what we're going to talk about today, but keep in mind, this delta is telling us what a $1 move in Caterpillar is going to mean to the position. This delta is what a $1 move in Pepsi is going to mean to that position. So when we sum this, it's kind of like, well, it kind of doesn't make that much sense. What you can do is you can then beta weight to a different index, like the SPX, and then it will compare your delta to that. But that's a little outside the scope today, and if you're not, I don't want to go down that rabbit hole right now. So yeah, you can group these together. You can look at your sum total, and if you want, you can even ungroup the whole shebang and say, I'm uncheck show groups, and it will just list them all out right there. Okay, so there you go. Now, because delta tells us how much that option is going to move compared to $1 move in the stock price, what if I don't want the delta so much? What if I do a different type trade? What if instead of a long put, I do a long put vertical? That's just adding multiple contracts on at once. So in this one, okay, we said we were going to buy our 130, okay, and that was a 48 delta. What if we did a spread though, and we did a 130, 128 long put vertical, okay? So in other words, we're going to buy, I'm going to put a little plus sign to indicate buy, the 130 put. I'm going to sell the 128 put. That together is going to be something we'd call a long put vertical, okay? It's just a way. Now, when we do a vertical, it changes things. And not only does it change things, but we can measure the change. So if I look at my delta here on my 130, it's negative 48. What's my delta on my 128? It says minus 29, but if we're going to sell that one, we're going to make it a positive delta. So what is my net delta? Okay, and the numbers are moving just a little bit. If I take my long put delta of 48 and I sum the two together, and my short put delta of positive, it's short, so I'm changing the sign on that, of 39, and I sum those, my delta on my trade is about 0.09. Okay, so if I do that long put vertical, instead of that 48 delta, I end up with a delta of about, I should say, negative 0.09. I end up with a delta of negative 0.09. So what does that mean? It means my profits or losses are going to move more slowly than with just the long put. I'm getting a lot of bang for the buck if I just do that long put. If Pepsi moves a buck or $5, I'm getting a big movement in that option price in my profit or loss, depending on which way it goes, whether it's going for me or against me. But if I reduce my delta down to 0.09, then if Pepsi moves a few dollars, it's going to be a much smaller effect on my overall portfolio. So one way to think about it, and is like a long put is more aggressive than a long put vertical if you consider it from the delta standpoint. All right? So same thing with a long call versus a long call vertical. That's one reason why people do vertical spreads, is it minimizes your delta. Okay? It also minimizes some of your other Greeks too, and I want to get to those other Greeks before I get too far into this here. But I could do that long put vertical. In fact, let me do that just to show you a demonstration of this. Okay, is I can click on the. Oh, by the way, what I can do is I can go up here to spread, single. I can go to deep and wide. I'm going to go 2 strikes wide. I'm going to make that a vertical. And we said 130, 128. Where's my delta? 0.09. That's exactly what we saw before by doing a little math. In this case, we don't have to do the math. Now, Eva said in the chat, it's the same with short puts. So every strategy has different deltas and different magnitudes of movement. In general, if you're just doing single options, long call, okay, long put, short call, short put, the delta is just the delta of that individual contract. But if you do start doing vertical spreads, okay, and Kevin said, can you talk about a vertical one? I'm not going to get too much into a vertical spread here because I just don't have time in our session. But we do, if you look at the playlist in this class, we have sessions on vertical spreads. You can also go to YouTube and do a search for vertical spreads, and you'll see other classes there. So maybe Connie, maybe you could help Kevin find a class on a vertical spread here. But a vertical spread is we're doing both of these contracts at the same time. So here's my 130, 128 long put vertical. I'm just going to click on that ask price, and I'm going to confirm and send. Actually, yeah, I'm going to confirm and send. And let me put this in my long verticals position. We'll pull that up. Let me just switch this back so I don't forget. I'm going to make that single. And if I look at my long verticals and we look at Pepsi there, you can see my delta. Compare those deltas, everybody. Look at those deltas. Here's my delta on this one. Here's my delta on just the single option there. Long put, Mr. Freeman said, is a long put the same as buying a put? Yes, it is. And I apologize if I didn't mention that before. Long put means you're buying it. If we say short put, it means we're selling it. Okay. Now, you may go, well, hey, that's great. That's really good. I want that. I like the idea of the big movement on that, on just say a single long put or a single long call. But why doesn't everybody always do that? Well, there's some negatives to it as well. And one of those negatives is this. It comes down to this. Time decay. Okay? Time decay. We've seen with Delta how the price of the stock affects that option price. How does time decay affect that option price? Well, let's take a look here. Okay, so let's go to Pepsi. Here's my long put. And let's see, I've got a theta column here. And let's look at my theta. My theta is about 720, negative 720, okay? And so negative 720 means I'm losing, everything else being equal, about $7.20 a day, or 718, or whatever the number is going to show, because it's a negative sign. We're losing that each day by holding this contract. Now, it's not a realized loss, and there's a lot of other factors in there. And you know what? In general, delta is going to affect the options fortunes more than the theta if the stock moves a lot. If Pepsi goes way down, it may not matter as much what theta does, or if Pepsi goes way up in price, because this is a long put, and this is a bearish trade. If Pepsi goes way up in price, we're probably going to lose money regardless of what theta regardless. But when I say everything else being equal, meaning the stock price isn't affecting it that much, implied volatility isn't affecting it that much, everything else being equal, we're losing about $7.20 a day here on this trade. Now, that's my Pepsi 130 put. Theta 720. What's that going to look like, do you think, if I look at it on the option chain? What do you think? Think about it. What's the number going to show? Is it going to show minus 7.24? Well, let's think about this. No, because remember, this multiplies it out by the contract. Let me go to this position again, and I look at my theta. It's rounded. If I had another digit here, it would say 0.072, because there's a multiplier with these options. This is a 100 multiplier. We're going to take whatever our theta is, and we're going to multiply it by 100 for the other page, times however many contracts I do. Okay. All right. So there you go. That's theta. Theta for long options, in other words, you buy a call or you buy a put, which is the example we just did, theta is going to be negative. Remember, if we're buying the option, we're going to keep the sign as is, and this is showing a negative sign here. This is showing a negative sign in front of those theta values for a long call. If we sell an option or do a short option, okay, those are synonymous terms, then we're going to reverse the sign. So in this case, these are all showing as 0.08. 0.08, if I sell a call or if I sell a put, then we're going to reverse that sign, and time decay is going to be benefiting us. So one reason why people do short options, this is not a recommendation, there's pros and cons to every trade. But one reason people do short options is you can make it so the time decay works for you. This is a measure of the daily change in your option price every day. $7 for the contract. Every day, $7 for the contract. Again, it's unrealized. This is a change in price dependent on time, whereas when we were talking about delta, it's not based on time as much. It's based on a change in the underlying stock's move there. Okay? All right. So Mario says, do you use value if the stock is going for you or against you, or is it just time decay? Delta, remember, when we're talking about Greeks, there's a lot of different factors that can affect the price of the option. Theta is not in isolation. None of this is in isolation. So it may look great if you do, say, a short put. If I were to sell this put here, I'm not actually going to submit the trade here. But if I click on this trade to sell a put, okay, so if I do that, that may sound great because my theta, I'm going to reverse the sign here because it's theta would be helping me out. The time decay is helping me out. But that doesn't do me any good if the stock goes way down, okay? Because if I sell a put, it's a bullish trade. Remember, I'm selling a put, not buying a put. If I sell a put, it's a bullish trade. If the stock goes way down, I'm probably going to lose a lot more on delta on the stock based on the stock price move than I gain on theta. Okay, so there you go. All right. Now, any questions on theta? I want to get those questions answered for you. But when we're talking about theta, what contracts are going to be for you? When does theta help you? In the case of a long put or a long call, in other words, if you're buying a call or buying a put, then theta is going to be working against you, okay? If you're doing a short call or a short put, theta is going to be working for you. What if you do a vertical spread where you're doing both at the same time? Let's look at a different stock here, okay? Let me go, and I'm going to do one that's maybe looking a little bit more bullish here. So I'm going to go to AMD, okay? Here's AMD, and I'm going to call this more bullish. Trend is up. We're above our 20-day moving average. There's no guarantee that the stock is going to continue to go up, but we're going to assume it is here, okay? So I'm going to go here, and I'm just going to look at a call option here on AMD. Okay. Let's say I just do a long call. Well, what's my delta? Well, I'll go at the money. We'll go to 138 call here, okay? My delta is 52, meaning if the stock goes up $1 from 137.57 to 138.57, then my option price is going to go up from about approximately 560 to about 610. Okay, just adding 52-cent delta to that. Okay, so that's my long call, right? What's my time decay on this? If I buy it, it's negative. I'm going to lose about $12 a day on this based on just time decay there. What if I do a spread though? What if I buy a call? We'll do this 138 call. What if we buy this one and we do a long call vertical and I sell this one? What's my delta? Well, my delta is going to be about 6 plus 0.06 times the 100 multiplier is about $6 move per dollar move in the stock price. What's my theta going to be? Not a huge difference here. I'm buying this one, so it's going to be negative 13. I'm selling this one, so I'm going to reverse the sign on that. That's going to be a positive 0.12. That means my theta is going to be about 0.01. That's why when you're doing vertical spreads, your option Greeks often are, well, invariably are going to be reduced, but sometimes they can get reduced so much that they're almost, I don't want to say insignificant, because that just depends on the trade. But sometimes, they could be considered that. Okay, it just depends on the trade and the extent of what they are. So, but you see how that theta gets significantly reduced? So one advantage of doing, say, a long call vertical versus just doing a long call is we can reduce the detrimental effects of time decay on us. Okay? Hoping that makes sense. Let me know if you have any questions on that. So that's theta. That's theta. And so just at the risk of repetition, let me just do this. I'm going to buy the call. Okay, I'm just going to buy this call option. And I'm going to confirm and send this. Put this in my long call, long single options. So this is AMD. Our delta is showing as 0.52. Our theta is showing as minus 0.13. What's it going to look like on this page? AMD, delta, about 52. Notice it's multiplied by 100. If I had two contracts here, this would show about 104 because I double it. Three contracts here, it'd be about 156 because I'd triple that. My theta, it's not showing as 0.12, it's showing as 1.2. So it's showing the total effect on my portfolio. Almost $12, almost $13 we're losing a day just because of time decay. The delta just depends whether the stock goes up or down. One thing about delta is we don't know which way the stock is going to go. We don't know how that's going to affect us. Theta, we do know. We know time decay is time moves one direction, right? Time moves one direction. Okay, now let's move forward to our next Greek. Okay, our next Greek is Vega, implied volatility. Implied volatility is just a measure of kind of the uncertainty priced into an option. Okay? As there's more uncertainty in the option, the more option prices, options tend to be more expensive. When the uncertainty or implied volatility goes out of the option pricing, then the option pricing tends to go lower. Let me just demonstrate that for you here. Let's pull up, we'll stick with AMD here for a sec, and I'm just going to pull up implied volatility. Notice, here's implied volatility. I'm not going to get too much into implied volatility today, but when we have an earnings event, very typically implied volatilities tend to go up before that earnings event. They go up. In this case, we had kind of a wacky market with a lot of extra uncertainty in the market, so implied volatility actually changed down a little bit before that event, but a lot of people will look for implied volatilities to go up in that event. And with long options, they tend to benefit from increases in implied volatility. Why? Because remember, I said the more uncertainty there is in option pricing, the higher the option prices go. If you buy a call, if I do a long call and option prices go up, everything else being equal, okay, remember everything else being equal, we don't know what the stock is doing, we don't know what the time decay may be working against us, but if option prices go up, it benefits. This is what we call positive vega. Positive vega. Implied volatility tend to help us. So in rising implied volatility environments, this tends to be a more popular strategy. Okay? Long calls. Same thing with long puts. Long puts are positive vega. If you anticipate the implied volatilities are going to go up, you may be more interested in doing a long put or a long call than short calls or short puts, because we're going to flip that sign, and implied volatility rising hurts us in the case of implied volatility is going down. So a lot of times as you get into options, there's a lot of different factors there. It's not simple. It's not always simple. And now, let's say I think the stock is going to, implied volatilities are going to go up on my stock, okay? And I think the stock is going to go up. Would I be more interested in a long put or a long call? Well, they're both positive vega, so that doesn't affect it. But if I'm bullish on the stock, I'd be more likely to buy the call, okay? If I find a bearish stock, I'd be more likely to buy the put in that case. So that's what implied volatility is. And I'm not going to go through the same process I went through earlier, but the same thing I said with theta is true with vega, in the sense that if you do a vertical spread, those vega values, you're just going to subtract one from the other on that vertical spread. So if I'm doing a long call and I have a positive 14 vega, but I make it a long call vertical, I'm going to subtract approximately a 14 vega. Vega becomes much less significant if you do a vertical. In fact, sometimes I listen to clients, listen to you guys, which are wonderful. And you often the question is, are you going to do that vertical spread? What about implied volatility on that? And sometimes my answer is, you know what? The implied volatility on a vertical spread, because the values are offsetting each other to a large extent, probably not 100%, but to a large extent, then it's probably much less of a factor than if you're just doing a long single option, okay? Than if you're doing a long single option. All right. Now, questions on Vega. Make sure you put, because there's one other Greek I want to go through here, and let me just let me do a quick refresher of where we're at. Okay, we talked about delta as being usually probably the biggest factor in our trades. What's the stock doing? And we're going to do our trade based on delta to a large extent. Time decay, long options, time decay works against you. Short options, time decay works for you. And that's measured as theta. Vega is a measure of how much implied volatility is going to do. In fact, something I didn't mention on this, what Vega is mentioning quantitatively is this: how much a 1% move in implied volatility is going to affect this trade. A 1% move in, well, let's look at this, okay? Here's my implied volatility, about 46, okay? So this is a higher implied volatility chart. If it goes to 47, how much is a trade going to affect? Well, if it's just a long option, if it goes up a percent, then we'd expect to gain about $14 on that. If implied volatility goes down 3%, I'd probably lose about $42 if I'm doing my math right there on there. Okay, so that's quantitatively how Vega works. Now, there's one other Greek on there that I want to mention. Okay, I didn't add it because if you're beginning, these are the three to learn first in my mind. Okay, in my mind, those are the first three to know. There is another one, another Greek that's called gamma. What gamma tells us is this. Gamma tells us how quickly delta changes and whether that change is going to push the delta up or down. If you do a long call, for example, and let's say we start with the 50 delta. I think we did a trade with something with about a 50 delta. Let's say it starts with a 50 delta. And if we have a positive gamma, and long calls have positive gammas, that means as this underlying stock goes up, that delta is going to go up. It's going to go up to 50, to 60, to 70, and so on as the stock continues to go up. Eventually, it would cap out at 100. Is that good or bad? Well, it can be beneficial in the case of a long call. In other words, as the stock goes up, the option is moving more and more impactfully in our direction on that. So we can make more and more money. But what if the stock goes down? Let's say we're doing the long call again. We're starting with that 50 delta, but our gamma is positive. As the stock goes against us, that delta is getting reduced. Say it goes down to 30. That means for every dollar the stock goes down, it's only going to harm us to the extent of 30 cents on the option rather than. So that's a benefit of long options, long calls, long puts. Your gamma is going to tend to help your delta. Now I'm just about out of time, but let me just mention this. In the case of short calls or short puts, okay, let's think of a short put. Let's say we do an out of the money, something with about a 30 delta put here. And the stock goes our direction. Okay, in other words, the stock goes up. Gamma is negative in that case. That means as the stock goes up, our delta is going to go down. In other words, we get diminishing returns the more the stock goes up. If the stock goes up a bunch, maybe that delta, instead of going to 30, to 20, maybe it goes down to 10 or 0. At a certain point, you just cap out and you're not going to make any more if you do a short call or short put, because that gamma is affecting your delta down. It's reducing that delta. Okay. None of the delta is not positive. It's not good or bad to have a high delta, but it just tells you how much the underlying option, the underlying stock is going to affect that option price. All right, folks, I am out of time. I appreciate you joining me today. We talked about the big three: the price, time, volatility, delta, theta, vega. Those are the first ones I want you to learn. And then as you're learning a little bit more, maybe we start to worry a little bit more about that gamma there. But I appreciate it. Coming up next, we have that market outlook mid-year, semi-annual market outlook. Make sure you check that out. Thank you very much. I think Cam normally teaches this class. I think he should be back next week. Everybody, have a great rest of the day. Bye-bye.